Welcome to a brand new episode of Dollars, Dirhams and Our Two Financial Cents. Today's episode is on UAE Federal Corporate Tax, and we are here to get an expert view from our guest today. We have with us Mr. Onali Merchant. Onali Merchant is an Associate Director with the Tax and Regulatory Practice at MMJS Consulting based out of Dubai. He has more than 10 years of core tax experience. Since his arrival in 2015, he has helped businesses in UAE and GCC with tax implementation, compliance and advisory, litigation, VAT and excise. He has been a key speaker on multiple platforms for tax-related topics. Welcome to this episode, Mr.
Thank you for having me.
Mr. Merchant, our first question today is, what is tax? Why corporate tax and why now?
So, tax can be a very complicated term, but to sort of dumb it down, tax is basically a compulsory levy which is recovered by governments across the world to fund their public expenditure. Taxes generally take two forms. One is indirect tax, which is in the form of a VAT or a GST or a goods and service tax, excise, a customs, basically the cost of doing trade. And the other side of the spectrum is a direct tax, which includes a corporate tax or a personal income tax or any other allied laws which regulate the income and capital of an individual. Why a corporate tax now is basically, I feel that it is about time that the UAE became more regulated. And that is why a corporate tax is being announced in the UAE. The announcement came on 31st Jan 2022. And it's part of a larger, initiative by the Organization of Economic Cooperation and Development, of which the UAE is a part of the inclusive framework of that particular initiative, which is known as the BEPS initiative. BEPS stands for Base Erosion and Profit Shifting. And there have been indications since as early as 2016 that taxes in some form or the other would sort of be implemented in the UAE based on plans to integrate the UAE into the larger global economic forum.
Right. So, from what I understand, UAE is one of the last countries in the GCC to implement corporate tax. We already have corporate tax in some of the other GCC countries.
Of course, yes. So we've had, a corporate tax at the federal level in all GCC countries except the UAE and Bahrain. It's a very little known fact that there has been a corporate tax in the UAE at the emirate level in Dubai, Sharjah and Abu Dhabi, which is currently applicable only to certain oil and gas companies and branches of foreign banks. So an income tax or a corporate tax is not a new, law to come into the UAE as such, but yes, a corporate tax law which is coming at the federal level will be something new.
So from what I understand from what you're saying is that we've already had a corporate tax law, but it has been on an emirate level and it's not been applicable to most companies, most businesses at present.
Yes,
okay.
That is correct.
So what do we know about the new tax laws? Do we have any details, or is it still up for discussion?
So, of course, whether it is up for discussion or not, that remains to be seen. What we do know is that on 31st Jan 2022, the Federal Tax Authority and the Ministry of Finance, the UAE Ministry of Finance, released two documents. One was a flyer, which contained 11 statements on what the UAE Federal Corporate Tax will look like. And the other document is a set of 31 frequently asked questions, which is on the Ministry of Finance website, which sort of give you a very high level overview of what is the intention of bringing or how the UAE Federal Corporate Tax will work, right? It does not give you insights or details into the what provisions would be contained in the law itself.
Okay.
But it does give you an idea of what will be taxed, how it will be taxed, and what would be the exemptions, tax incentives given to businesses which are subject to corporate tax. So to give you an example, the FAQs and the flyer, they both say that the standard corporate tax in the UAE will be at 9%. And the federal corporate tax will be applied on a slab basis. What I mean by slab basis is that taxable income up to 375,000 would be subject to a corporate tax at the rate of 0%, and any income above that threshold would be subject to corporate tax at 9%. The FAQs also say that large multinational entities which have a global revenue of euro 750 million and above could be subject to a higher corporate tax rate. Now, this is in line with the proposals set out by the OECD under the BEPS 2.0 initiative.
Is this what they call the global minimum tax?
Yes, this is what they call the global minimum tax. And if you have tracked, news reports back in July 2021, there was a statement that was released by the OECD, which which is known as the BEPS 2.0 two-pillar solution.
Okay.
In which this is a part of Pillar 2, in which it is proposed that there should be a global minimum tax base or a global minimum tax rate of 15% applicable to multinational entities which are operating in multiple jurisdictions above a revenue threshold of 750 million. Now, this was, signed off by the UAE and Bahrain, and also it was endorsed by another 149 countries across the world.
Okay. So, I mean, from what I understand, so corporate tax generally, or tax in any form, is looked at very negatively. Nobody likes paying taxes, everyone says, death and taxes are two things you can't avoid. Definitely. So, it's always got a negative view to it. But there is also the other side to it, where corporate tax is viewed as something that will bring more legitimacy and could add an impetus to the UAE economy. Is there any truth to that? Can you shed some light on that?
So on both counts, I would tend to agree with you. Now let's take it. Now let me give you a couple of examples to explain my thoughts. Of course, tax is viewed negatively because it directly impacts the person that is paying it. So in the case of an indirect tax, say a value-added tax, VAT, which is 5% in the UAE, right, as of now, the end consumer bears that cost. So right, in essence, his purchase price has increased by 5%. In the case of a corporate tax, the tax is applied on the taxable income and or capital gains of a particular business, which is currently contemplated in the UAE. And hence his take home is reduced by 9%.
Right.
Of course, since it is optically visible, the general perception is that it's a cost to me.
Right.
However, even if taxes were not there, any government will need revenue for public expenditure. So they would recover this revenue from you in the form of fees.
Correct.
Or any other levies or government service charges. To give you an example of this is tax residency certificates. While it was with the Ministry of Finance not too long ago, the statutory charge for issuing a tax residency certificate was 10,000 dirhams.
Right.
That has been reduced to 1,750 dirhams recently.
Oh, okay.
Approximately 1,750. So there will obviously be a rationalization of government service fees and levies in the advent of a corporate tax or any other taxes. Now, the UAE government has already announced that it is undertaking a review of the existing government levies,
Okay.
so that certain portion of that cost of doing business in the UAE can be offset.
So that's fascinating. So you're saying that while there will be an introduction of a new statutory tax, there will be a rationalization of other expenses that a business currently has.
Generally,
to a certain
yes.
extent, of course.
Generally, the governments all across the world try to minimize the impact or the cost burden on a business or an individual. And of course, UAE has announced it. It was announced not too long ago that they are reassessing, and will rationalize government fees and service charges. Now, coming to the other, aspect of the question that you asked me is tax good for you? So, tax is definitely good for the economy as a whole.
Okay.
Right? Whenever you have a regulatory structure, you have tax transparency, you have a tax structure in a particular jurisdiction. This boosts investor confidence. What I mean is that in the absence of a regulatory framework or a tax framework, in a structured manner, key decisions or key policy decisions tend to be subject to whims and to whims of a particular individual or a particular group of individuals.
I see.
When you have a law or when you have a regulatory framework under which a business operates, it basically boosts investor confidence, saying that, okay, this is not subject to a bias. It's an unbiased regulatory environment in which I'm operating. So in the long run, the economy will become more robust, it will grow, and in turn, businesses will get multiple opportunities to grow also.
Right. Okay.
So this is basically my opinion on how it should work out. There will be a jolt. There will be sort of a culture shock. This we saw during 2017, 2018, when excise and VAT were implemented. It was rather than people or businesses not willing to pay the tax, but a culture shock that now a tax is levied on us.
Correct. Of course. I remember those times. Yeah.
So once we, tied that particular, period of maybe a year or two, you would be able to see the advantages that a corporate tax or further tax regulation brings to the UAE.
Right. So Singapore is an example of something like that, right? I mean, they had no tax.
Yes. So Singapore, there are many other examples when you have smaller countries which sort of go through a life cycle. So during the early days of a country, and I'm not necessarily saying that the UAE has followed this, but whenever a country sets out on its own or begins to grow, it needs investment first. Right. That's the first part of the life cycle. After it gets the investment, it then needs to regulate business which is growing. That is the second part of a life cycle. And then once the jurisdiction matures, right, then everything becomes a routine. So you have a different set of regulations for each life cycle or each stage in which a company grows. So Singapore started off much earlier than the UAE. So it's somewhere further down, that particular stage.
Cycle, right.
That cycle, the UAE, of course, needs to sort of integrate itself with the global economy. And it is going into that direction also.
Okay. So now, from what we've discussed till now, we know the quantum of tax.
Yeah.
But we still don't know a lot of details.
Okay.
How has it been implemented in the GCC, in other countries? Because can we get some idea of how the tax regulation will look here considering how it's been implemented in our neighboring countries?
So logically speaking, the GCC itself is one common economic zone. We have a common GCC, a customs law. We have a common GCC VAT, a framework. We have a common GCC excise, a framework. So definitely, more likely than not, the federal corporate tax law that is to be issued in the UAE should somewhere mirror the fundamentals that is existing across the GCC as we speak, and KSA being the biggest tax jurisdiction in the GCC, the UAE government could borrow a lot of fundamentals from there.
Okay.
And the intent from that particular tax law. But having said that, based on what we've seen in the UAE VAT law, there are a lot of aspects that have been borrowed from other tax jurisdictions as well. So what I would expect is a mix.
Okay.
Not a very equal mix. Maybe it could be biased towards the GCC, but yes, what I would expect is a mix of provisions to be contained in the tax law itself.
Okay. And when is this expected to come into force?
So the announcement particularly said that corporate tax will be applicable for financial years beginning on or after 1st June 2023.
Okay.
What that basically means is that if your financial year is from, say, a January to a December, your first tax year will begin on 1st Jan 2024.
Okay.
With your first compliance triggering in 2025. If your financial year is July to June and your financial year begins on 1st of July, then corporate tax will be applicable to that entity on 1st July 2023 itself.
Okay.
With the first compliance most probably triggering in the second half of 2024.
So considering that timeline, do you think businesses should start preparing for something like that from today? And if so, how should they go about doing that?
Based on the experience that we had during VAT and excise implementation, it is always better to start early. Corporate tax itself is a very complicated, concept, right?
Right.
It's basically a tax on your taxable income. Now, taxable income itself is derived from by making adjustments to your reported financial earnings.
Right.
Right. So the adjustments themselves, the positions that you take for those adjustments need time. Then maybe you require restructuring. Maybe you require rationalization in the business model that you're doing to come in line and be efficient from a tax perspective. Now, depending upon your organization size, businesses and finance functions, CFOs, they need to take an informed a decision when they want to start.
Okay.
Because bigger the organization, the slower it moves.
Okay.
The smaller the organization, the faster it will move.
Right.
So if tomorrow an SME were to ask me, I would say, all right, it's fine. Maybe you should wait for the law. But if there was, if it was a bigger organization with a lot of stakeholders that need to do things to bring things into line, I would recommend to start as soon as possible, because we have enough information with us to take educated, take an educated guess, for
Correct.
want of a better word, of how the law will be structured based on experience across the GCC and other tax jurisdictions, and at least start laying the groundwork of how corporate tax could be implemented for their organizations.
Okay. So, I mean, you mentioned SMEs. So, if I say I am a small business owner, and you mentioned the tax will be on my income.
Yes.
On my taxable income.
Yes.
So, the first worry that comes to a small business owner is that automatically his income will reduce.
Yes, definitely.
So, like in a lot of countries, there are exemptions that you can use as deductions to your tax liability.
Yep.
Are we expecting provisions like that whereby certain expenses or certain deductions can be offset against your tax liability?
So the FAQs have announced, and the flyer itself has announced a lot of tax incentives that will be contained in the corporate tax law. Now, the FAQs, as of now, they don't give you insights into sector-wise or line item-wise exemptions or incentives that would be available. The few incentives that have been announced is basically your tax losses will be allowed to be carry forward for a certain number of years and set off against future taxable income. That is one incentive that has been announced. It has been announced that capital gains should not be subject to tax in the UAE if it is not a business activity.
Okay.
Another incentive that has been announced is the fiscal unity, a concept where you have say multiple entities under a common shareholding or connected in such a way that it becomes administratively easier to file one tax return for the entire group. That fiscal unity concept has been announced. A key announcement is basically an exemption for free zone companies. Now, as you might be aware, UAE has, I don't know, in excess of 44, 45 free zones.
Sure. Yeah.
And each of these free zones contain a tax exemption clause.
Okay.
Right. So what the FAQ says is that the UAE Federal Corporate Tax will honor any tax exemption committed to a free zone entity by the authority.
Okay.
Right. So basically the way it will work is that all free zone companies subject to meeting all regulatory compliances and not conducting business in the UAE with the UAE mainland should be eligible to claim an exemption for their taxable income.
Okay, so correct me if my understanding is correct. If I'm a free zone company, if I'm the owner of a free zone company and I do business inside the free zone only, not with another country, not with the mainland, I am exempt from, I can ask for an exemption on the federal tax liability.
So what it does not mean is that federal corporate tax is not applicable to you. Federal corporate tax is applicable to you.
Okay.
You will be treated as a taxable entity. However, based on the tax exemption given to you by your free zone authority, it can be anything. The tax exemption could be for dividends. The tax exemption could be for service, income. The tax exemption could be for goods sold within the free zone. Based on that tax exemption given to you by your free zone authority, you will be able to claim an exemption against your taxable, income. But it certainly does not mean that federal corporate tax is not applicable to you.
That's, I think, quite interesting.
So, apart from the free zone exemptions that have been announced, the FAQs also talk about individuals, the personal income of individuals not being subject to tax. What it means is basically salary, the salary income or any other type of income which is personal in nature for the individual. It can be a rental, it can be interest on bank deposits.
Okay.
This income will not be subject to tax in the UAE. But where an individual is giving services,
okay,
where that individual needs to obtain a trade license in the UAE to operate, such income will be subject to tax in the UAE.
Okay, so correct me if I'm wrong. If I'm a business and I have, say, a capital investment, and if I make gains on that, that capital gains is not subject to corporate tax.
Should not be subject to a corporate tax.
From our current understanding, until the laws are out.
If that capital gains is personal in nature.
Okay.
If a business or an entity earns capital gains in the UAE, then that could be subject to corporate tax in the UAE.
So if I'm a business owner and I have investments, that does not come into the purview of this tax.
Precisely.
Okay. I mean, it sounds, obviously we still have a lot to find out once the tax laws are out. Is there any timeline when we expect those to be out in detail?
So what we've heard is that, the corporate tax law could be out as early as June 2022, which will be immediately followed by the implementing regulations. So unlike, the VAT implementation, you should have enough time, or businesses should have enough time to take measures to come in line with the law.
Okay. So, for a layman's understanding, what is the methodology of calculating this tax? What is the limit up to which there is no tax? And after that, what is the methodology for calculation of tax? Because a lot of us in this jurisdiction are not used to paying taxes. So just for the benefit of our audience, if you can give us a little brief on how it might be calculated.
So the computation methodology would be a mercantile one. So
sorry, what is a mercantile one? You're gonna have to explain
I was
that.
just about to explain that. So the mercantile method is based on accruals, and the cash method is based on actual realization of cash.
Okay.
So the tax computation will be based on the mercantile method. The computation methodology will be, you will start with the net income that is reported in your financials.
Right.
There will be certain disallowances. Mostly it would be depreciation as per the accounting standards, and there could be depreciation rates in the tax law itself. So that is one of the very usual adjustment that we see for corporate tax purposes. So you have a disallowance, then you have specific allowances, then you will have specific exemptions, and then you arrive at a taxable income.
Okay.
From that taxable income, your income, say after all of the adjustments, you have an income of 500,000, right? So out of that, 375,000 would be subject to tax at 0%.
Okay.
The balance 125,000 would be subject to tax at 9%.
Flat. Anything over 375,000
It's flat 9%.
is flat 9%.
Yes.
Okay. That sounds simple enough.
It sounds simple, enough, but it might not be as simple as you think, or as most businesses might think, because there could be a lot, and we have experienced this, that there could be a lot of ambiguities in how the deductions and the disallowances are applied. The FAQs also speak about the net income that is taken as a base or as a starting point of your tax computation should be arrived at as per applicable international accounting standards, which in general mean the IFRS accounting standards. Now, in more likely than not, in the unregulated environment that the UAE has been till now, in more likely than not, there could be deviations in financial statements themselves from IFRS.
Okay.
So basically, the first challenge, if at all, that comes from the FTA or the regulator, who is the regulator for corporate tax also, could be whether your financials are as per governing accounting standards or not. Right. Since no reporting or no statutory reporting was required for financial statements, there is that risk that compromises or adjustments were made to the applicability of IFRS for reporting purposes.
Right.
Now that will not be the case.
So you're saying audited. So, from my personal experience, I come across a lot of businesses that don't even do audits at the moment.
Yes.
That is something that they'll have to now start doing
Yes.
Ideally, as soon as possible.
Ideally, yes. So to sort of substantiate and support, the net income, the basically in technical terms, we say a profit before tax. The net income that is being reported in the financial statements. And audit, though as per the FAQ is not mandatory as of now, but they will need to start making their financials as per IFRS, and of course having them audited by an independent advisor or an auditor.
So is that not just the tax component? A lot of businesses will also look at this as an expense. Tax compliance itself is also sometimes looked at as an expense. Yes. But in the long run, from my understanding, this will only legitimize their business and make it easier to transact globally, because I come across people who want to do business outside, but they just don't seem to be prepared. And something like this, a law like this, will force you to prepare for an environment which is regulated, which will automatically be seen as something more robust by outside entities as well, probably.
Definitely. So from an investment perspective, if I were to speak, let's assume that I am in, located in the UK, and I want to invest in your business, which is located in the UAE, and you present to me financial statements,
right,
which are unaudited.
Right.
My risk perception increases at that point of time.
Correct. Automatically, yes.
Right? Then let's take another scenario that you present to me financial statements which are not as per internationally accepted accounting standards. Though my risk perception might not be as high as the unaudited financial statements, still my risk perception will be quite high because it is not as per IFRS, because I cannot rely on the numbers or the amounts that have been reported in that statement. But if you give me audited IFRS compliant financial statements, my risk perception lowers. Immediately. Because I can trust the amounts that have been reported in those financial statements. However, along with that, if I get a corporate tax, a return, that this number has been reported to the regulator in the UAE, my reliance on your reported numbers increases.
Correct, because then it's not just a number that I've put on paper.
Precisely.
It's something I've paid tax on.
Yes.
That means it is an actual income.
Yes.
I think I see it as a positive.
Of course.
Because even in my business, in order to verify financials, I come across unaudited or audited financials which don't conform to any standards, and it becomes difficult to verify those figures in any way. So I think that it will be really helpful for all of us.
Definitely, and apart from giving you a reliance on the amounts, the tax framework itself sort of will rationalize bona fides, or will establish the bona fides of the economy as a whole. Right, because till now UAE was taxing only one side of the spectrum.
Correct.
Now it will be taxing the whole spectrum.
Right.
Which definitely will be subject to oversight on the whole economy as such. So tax transparency is a big, reason why these measures are being taken, and of course, based on the commitments that the UAE has to the OECD in implementing the global minimum tax, which would have been due next year. This was inevitable.
Right. So, I mean, does that also make the economy more robust, in the sense, today if I am transacting with another business in the region, for me now knowing that they are doing the regulatory requirements, they are conforming to the rules and regulations of the country, automatically gives me more comfort in dealing with them.
Yes, definitely. So cross-border transactions up till now in the absence of tax, say in one of the countries, always had the risk that profits would be shifted from the taxable country to the non-taxed or the low-taxed jurisdiction. With a UAE coming up with a corporate tax now, though not commensurate to the rates that are prevalent in the GCC itself, or at least in the Middle East region, UAE is still the lowest corporate tax rate, one of the lowest corporate tax rates in the world. So, but it does reduce the risks of cross-border transactions, at least from a government policy perspective.
Okay.
That if it is not taxed in one jurisdiction, it will be somewhere or somewhat taxed in the other jurisdiction. Another, which reminds me that another, measure that is announced, or another incentive that has been announced in the FAQs, is that cross-border transactions. That if I were to deal with Saudi Arabia,
correct,
and I'm earning income from Saudi Arabia, my income is subject to a tax withholding in Saudi Arabia. Now, the tax withholding that has been done at the Saudi Arabia level would be available as a set-off against my corporate tax liability in the UAE, which is known as foreign tax credit, the FTC.
Right.
So even that is part of the incentives that I was talking about.
So you're saying with those incentives, it could reduce your tax liability as a whole?
Definitely. So apart from the incentives that I spoke about, this and what I'm about to say now is not has not been announced as such, but you can reasonably expect sector-specific, industry-specific incentives that will be brought into the law. Now, the most common incentives we see is research and development expenses, right? So, if you have R&D expenses, you could the UAE government could incentivize that, and they could give you an equivalent additional deduction for the R&D expenses that you have done. There could be reinvestment exemptions, that if you reinvest into the business to grow, that means you don't take out the funds as a dividend or any other cash repatriation, and you reinvest that funds into the business, you could get an exemption for that.
Okay.
So there could be sector specific incentives for heavy industry, for the oil and gas allied industry, because oil and gas would still be subject to emirate level taxation.
Okay.
But the banks will move to the federal corporate tax.
Okay.
So sector specific incentives also could be given, but we need to wait and watch for more information on that.
But the R&D and the reinvestment part, I think, is quite interesting. That means if the money is used for purposes like innovation, for reinvesting in the same economy, in the same country, automatically it helps the economy as a whole. Grow faster. Yeah, I think that.
And with the impetus that the UAE government puts on innovation, I don't think it would be a surprise if something on these lines make their way into the corporate tax law.
Oh, that's nice. So since we're talking about all tax, how much money are we expected, or how much money is the UAE government expecting to make from the corporate tax? Is there a number that experts have filed, or is there something that you have in mind that you think is a reasonable estimate of the corporate tax income the UAE government can make?
So it becomes very difficult to estimate government revenue in the absence of a base.
Of course.
As I said, or as you said, that reporting of financial numbers for a large part of the UAE market is not mandatory.
Right.
That information is not available with at least in the public domain.
Correct.
So putting a number on it or an estimate in the absence of base information becomes very difficult. But if I were to put in a guess, for want of a better word again, I would say the UAE government can hope or maybe target between 8 to 10 billion AED in the first year itself.
That sounds
of application. Now the calculation of that 8 to 10 billion AED would also be staggered over a period, because you will have some tax years beginning on the 1st of July 2023. You will have another set of tax years beginning on the 1st of October 2023. You will have a third set beginning on the 1st of Jan 2024. You will have a fourth set beginning on the 1st of April 2024. So for the first couple of years, putting a number to an estimated annual revenue is very, very difficult, but it could be somewhere in this range.
Okay. I think that's a good guess, I'm guessing. So
I'm being as conservative as I can, sir.
No, it's always when it comes to money, I tell people to be conservative when you're estimating anything, because at the end of the day, it's an estimate. So it's always best to be conservative in that. Can you shed some light on tax treaties? This is something that we come across a lot of times, and from my understanding, the UAE already has a lot of tax treaties. So in that case, how does it affect corporate tax as as a whole?
So tax treaties do not affect the domestic tax laws per se.
Okay.
A tax treaty is basically an agreement between two tax jurisdictions to avoid double taxation. So in many scenarios, a particular income, say earned in Saudi Arabia, could be subject to tax in Saudi Arabia. And when that income is brought into the UAE, or comes into the UAE, it could be subject to tax also in the UAE.
Okay.
Let me give you a simple example. Now, the way the FAQs have been, the UAE Federal Corporate Tax FAQs are worded, the worldwide taxable income of tax residents in the UAE would be taxable here.
Okay.
Right? But I could have earned income through services I gave in Saudi Arabia.
Right.
Now, Saudi Arabia has a right to tax that income because you earned that income in Saudi Arabia. And for simplicity's sake, you incur 10% corporate tax there.
Sure.
When you bring that income back into the UAE, that will be subject to a 9% corporate tax here as well. Because you are tax resident here in the UAE.
That doesn't sound right, though.
No, it can happen. So tax treaties sort of make the rules that what are the taxing rights of each entity. So it might say that Saudi Arabia cannot tax this at 10%. The maximum Saudi Arabia can tax it is at 1%.
Okay.
And then that tax paid in Saudi Arabia would be available as a tax credit back in the UAE.
Okay.
So it sets out the taxing rights of cross-border transactions between two tax jurisdictions. It's a mutual bilateral agreement.
Okay.
There are standard templates available from the OECD, from the UN, and there is another model known as the US. And most US tax treaties are based on the US tax model. Most treaties across the world are based on the OECD tax treaty model, which is more equal to both the countries. So that is the basic function of a tax a treaty. To access a tax treaty, the fundamental document that is required is a tax residency certificate from one of the countries which are under the tax a treaty to avail a tax treaty benefit.
Okay, that sounds a lot. So tell us, how do you add value in your business to entities who need help with tax implementation?
So the value that we add is we sort of try to guide businesses in the UAE in the right direction, right? It's not merely about giving you technical jargon that you don't understand in the first place. It's about walking with you through the process itself.
Okay.
So any implementation, and most businesses in the UAE might have realized this during an excise implementation or a VAT implementation, that the entire implementation is a process in itself. Every stage, you need to take a call, you need to take a decision on what needs to be done going forward.
Okay.
So our value proposition is that we walk with you from beginning till the end. Try to fit your business as efficiently as possible into the tax law that is going to be announced or has been announced or is going to be implemented, having that due regard to business sensitivities. What we do for clients is we, from a direct tax perspective, we have a whole spectrum of or a whole palette of services that we can offer, from international tax to corporate tax to transfer pricing. And while I'm on the subject of transfer pricing, the FAQs also say that any related party transactions within the group of companies should conform to OECD transfer pricing guidelines. So that's another compliance that will come, and another aspect that most businesses must take note of.
Okay.
Because transfer pricing documentation can be extremely complicated based on the methodologies given under law. So we still need to wait what the actual law will say about transfer pricing. But yes, transfer pricing should be good. And on top of that, big groups should also take care that they might need to give due consideration to the applicability of global minimum tax, because those provisions will also be there in the corporate tax law.
Wow, that sounds like we have enough material for a few more episodes.
Definitely, because each aspect that I'm talking about, if we were to delve into it adequately, we would need at least an hour each.
All right. Well, thank you so much. Thank you so much for joining us today and giving us your views on corporate tax. We really appreciate that.
A pleasure to be here.
Thank you.